All right, let's kick things off with a story that might actually surprise you. It's about one of the smartest people who ever lived, making one of the dumbest financial mistakes in history. And this story, it reveals something fundamental about money, markets, and, well, our own brains.
And that quote, it's from none other than Sir Isaac Newton. Yeah, that Isaac Newton, the guy who came up with the laws of motion and universal gravitation. He could literally figure out how the universe works. But when it came to the stock market, turns out he was just as vulnerable to hype and panic as anyone else.
And that little slip-up, it cost him this much, $3 million in today's money. See, back in the spring of 1720, Newton cashed out his shares in a company, doubling his money. Smart move, right? But then, just a few months later, he got sucked right back into the frenzy, bought back in at a much, much higher price, and got completely wiped out.
It's a fair question, isn't it? I mean, if a certified genius, Newton himself, couldn't protect himself from the madness of the people, how are we supposed to navigate the emotional roller coaster of investing? Well, the answer, it turns out, isn't about having a bigger brain. It's about having a better framework.
And that is where a guy named Benjamin Graham comes in. He's known as the father of value investing, and he wrote the book on the subject. Literally, it's called The Intelligent Investor. His whole philosophy is basically designed as a shield, a defense against that market madness. And it's all built on two core principles.
Okay, first things first, you have to know the difference between investing and speculating. Graham was super clear on this. An investor, they're buying a piece of a real business. They analyze it, they understand it. A speculator, they're just gambling on which way the little line on the screen is going to go, hoping someone else will pay more later. They're watching the ticker, not the business.
And that leads us to what is maybe Graham's single most important idea ever, the margin of safety. It sounds fancy, but it's breathtakingly simple. It just means you only buy something when it's selling for way less than what you've calculated it's actually worth. That gap, that difference between price and value, that's your cushion. That's your ultimate protection against a future you can't predict and your own mistakes.
Now, I know what you might be thinking. This all sounds like some solid, old school advice, but does it really hold up today in our crazy high-tech world? Can a framework from the 1940s really help us make sense of the market right now? Well, you know what? Let's put it to the test.
And for our little experiment, we're going to use something you'd probably never expect, a 2025 market report on the Canadian jeans and kidswear industry. Yeah, I know. It's about as modern and specific as you can get. So, can Graham's timeless principles help us break down a real-world business today? Let's find out.
All right, let's pop on our intelligent investor glasses and take a look at what this report is really telling us. And remember, we're not just guessing about fashion trends here. We are analyzing a business.
So rule number one from Graham, understand the business. And the report gives us a pretty clear look at the good stuff, the opportunities. We're seeing e-commerce is just booming. Consumers are really hungry for sustainable and ethically made products, and new little niche markets are popping up. So yeah, the potential for growth, it's definitely there. But a real analysis, an intelligent one, always looks at both sides of the coin. And the report also lays out some pretty big risks. Supply chains are, well, they're still a mess. The wider economy is murky, to say the least. You've got potential tariffs that could mess with costs, and who really knows what the next generation is going to want to wear? An intelligent investor never, ever ignores the challenges.
Okay, now this next part is so crucial. A great story about sustainable jeans is powerful, but Graham would tell you that we have to ground our analysis in the cold, hard numbers. Stories create hype, numbers create clarity. So let's dig into the data. What does it actually say? Well, the report shows that in 2025, the kidswear market is actually a little bit bigger than the denim market up in Canada. We're talking $5.64 billion for kidswear and about $5 billion for denim. Okay, so that's our baseline.
But this is where it gets really interesting. Check out the growth projections. The denim market, even though it's a bit smaller right now, is expected to grow at almost 7% a year. And the kidswear market, just over 2%. See? The numbers are telling a totally different story about the future than the snapshot of today would suggest. This is the kind of insight that separates a real investor from a speculator.
Okay, so we've looked at the business, we've crunched the numbers, now we circle back to Graham's big idea. How do we actually build our margin of safety? Well, this is where all those risks we talked about suddenly become our best friend.
And this is the genius of the mindset shift. You don't run away from the risks. You look them right in the eye. You price them into your calculation, and you use them to demand a discount. That discount, that's your margin of safety. So if those supply chain problems get even worse, or that 7% growth in denim doesn't quite happen, your lower price acts as a buffer. It protects you.
So let's zoom out for a second. What's the big takeaway here? Is it that you should run out and invest in Canadian denim companies? No, absolutely not. It was never really about the jeans.
The whole point, the thing that matters, is the process. This framework, knowing the difference between investing and speculating, looking at the pros and cons, grounding it all in numbers, and always demanding a margin of safety, this is a universal toolkit for making rational decisions about pretty much anything.
So let's bring it full circle. That margin of safety, it's not just some finance jargon. It's a way of thinking. It's the buffer you create between what something costs and what it's worth, between the hype and the reality. It is the one thing that could have saved a genius like Sir Isaac Newton from the madness of the crowd.
And look, this doesn't just apply to stocks. Think about it. It applies to career moves, buying a house, any huge decision where excitement and hype can get in the way of clear thinking. So I'll leave you with this. Where is the hype in your world? And what's your margin of safety?